I'm here today with Dan Biron. He's the Managing Director and Head of Healthcare Platforms at the investment bank Lancaster Pollard. Lancaster's involved in a lot of areas of senior housing finance, from tax-exempt bonds to HUD to Fannie Mae. Where do you see the bulk of your financing activities for 2011?
2011 at this point is going to be primarily FHA HUD financing, 232 program. With the large queue of HUD, we basically feel that our pipeline's kind of already cooked at this point. We're also looking at a number of Fannie transactions as well, but I think the lying share is going to be also the 232 FHA program.
And do you think it's going to be easier in 2011 to get deals done than last year?
I think it's going to be very consistent on the 232 side. They made an indication that they were going to hire 25 new staff. Of the 25, I believe they've hired 6 to 7, and the majority of those hires were all in the administration role. They were not underwriters, and so I think it's still going to be a long queue. We basically tell our clients it's anywhere from 10 to 12 months to attain a commitment. What appears to be happening now is there's also a closing queue that's occurring, and so it could take 2 to 3 months to close a deal subsequent to a commitment. The positive, though, is once you have a commitment in hand, you can do your interest rate lock. So you have a sense of, you're not going to have that interest rate risk at that point. So the 10 to 12 months to the commitment, you've got interest rate risk at that point that it could swing.
Yeah, because a HUD lien was supposed to fix some of the problems with the queue, but there was such demand. Precisely. Obviously, HUD didn't and couldn't staff up for it. But once you get that, when you lock in that commitment, you have that 8 to 10 months of risk. What's the time period from then that you have risk to closing?
It's probably anywhere from 2 to 3 months from commitment to closing.
But that's locked in.
But that's locked in, so you don't have interest rate lock. That's right.
What's your feeling about the Obama administration's current proposal to, I guess they call it winding down Fannie Mae and Freddie Mac, and the impact that's going to have on seniors housing? Because that's a big takeout area.
It is. I think if it stays as proposed, I think it will have a very large impact to the senior housing industry. But I think it's still too early to tell. I think between now and the year 3 to 4 years from now, when it gets implemented, I think a lot is going to be changed. There's potential that the same program where the Fannie debt is securitized could be privatized and could take certain pieces of it could be taken and done more privately. So I think there's so many different opportunities, and it's going to depend on the groups that step up to say, hey, there's an opportunity here, let's benefit from this. So I think it's still very early to tell.
Well, the flip side, if Fannie Freddie debt, the cost of that debt goes up, it'll attract more private capital in theory. So there'll be more sources, albeit at a higher cost.
That's right. That's right.
So hopefully that'll be one of the outcomes.
But it's still very early to tell.
And what are most of your clients trying to achieve in the debt markets today? Is it just purely refinancing to take advantage of these low interest rates right now, or
the majority of the FHA debt, yes, is to try to get lower interest rates. Our volume of A7s, which is a refinancing of an existing HUD loan, we've done quite a few of those as well, because people are seeing that the interest rates are so low.
Mm-hmm.
Today you're probably at 475 with the mortgage insurance as well included in there, and so it's some great rates. And folks that closed loans 2 or 3 years ago, 4 years ago, are basically back saying, let's refinance this HUD debt at this point at a lower rate.
And is HUD, with the long queue and a number of properties in there, is HUD favoring the refi or favoring the new finance, since it's kind of like, well, we just saw you 3 or 4 years ago?
I don't think there's any favoring on either side. They're getting them done as efficiently as they can, and so they look at the refis. They make sure that the repayment period is reasonable. If the repayment period is excessive, they're going to turn them down. But I think if they're within the 10-year range, I think they'll consider them and they'll approve them.
And from your perspective in looking at these markets, do you see the credit markets at all easing, or is it just pretty much status quo with last year?
They're easing. I think since the NIC in September in Chicago to now, I think you're seeing more groups stepping up. Interest rate, the cost of money is still staying slightly better than a year ago, but it's starting to appear to loosen up at this point. And I think you're going to see over the next several months, it's going to continue to loosen up.
And Lancaster Pollard has been doing some work in the M&A side of the business. Is that something that's going to be growing there?
We have an opportunity that we do a lot of work with the not-for-profits. And so some not-for-profits will approach us and say, we just want out of this business. And so that's where we've probably attained the greatest number of M&A transactions. We are in, we know a lot of people in the industry, and so we quietly go out to these individuals and say, hey, this building is available, would you be interested in looking at it? We try not to blanket the market with emails that go across to everyone that's in the industry. We quietly, strategically pick individuals that are doing more of the strategic buy versus the opportunity buy. And so that's where a lot of our M&A businesses come from. That still continues.
So the buyers that you deal with, are they looking more for the stabilized properties and not the opportunistic, non-stabilized?
It's been a mixed bag. When I say opportunity, more the equity buyer. The strategic buyers are who we're presenting to. And so it's been a mixed group. There are some that feel that they're turnaround folks and they can step into a building and turn the thing around. We have some individuals that will even look at buildings that have lost their license, and that will flip into there and either attain a license back or change the use of the building. Mm-hmm. So and those transactions are coming from more the FHA distressed assets. FHA has taken kind of a different attitude in the last 2 to 3 years. Several years ago, they would just, if a project was going sideways, they'd just put their hands up and say, okay, it's an insurance claim. Today, they have a very different attitude. They like partial claims. They like turning a building around or getting a new operator in there and not having any claim. So we've been very involved with HUD and the asset management folks to try to be aware of these transactions and getting a strategic buyer who can turn the property around. So it's kind of varied in our M&A business.
Well, I know there's been some on the HUD side. I know on the Fannie and Freddie side there's been very, very few defaults, if really any, so the track record has been good.
Last year for HUD there were 11 full claims, which is a considerable decline in the number of claims from the years past. They really try to work with the borrower and come up with a solution, or they change the operator.
11 out of the entire HUD 232
yeah, and I think
portfolio.
it's in excess of 2,000 HUD loans that the 232 program represents. So that's pretty good. And it's a money-making, center for the federal government, and so it's not a bad program. But it's a changed attitude. They really work with the borrower, and if they see troubled issues, they try to get in there and work with them and come up with a solution.
Too bad the residential housing market doesn't have that same kind of a track record.
Yeah, it does not. It does not.
All right. Well, thanks for the update on what you're doing, and hope you have a busy year this year.
I'm sure we will.
Okay,
Thank you.
Thanks.